Hello, my name is Tyler Moore. I am a financial planner with Timberchase Financial. Today I'm going to be walking through financial planning for physicians, specifically medical students about to start their first year of residency. This is the second video in a two-part series, so make sure you check out the other video. Through both of these videos, I'm walking through the pillars of financial planning. In the first video, I covered cash flow and debt and retirement planning. In this video, I'm going to walk through investment planning, so the different investment principles that you can control, that you can't control, who you should work with, things like that. And then I'm going to walk through insurance planning, the different types of insurance policies that you need to be looking at, things to consider with each one, and then briefly going to talk on estate planning and what situations you need to be looking at and considering estate planning. So starting with investment principles, um, there are many principles that for investing that you can control and those that you can't control. I'm going to start with the ones that you can control, and the first one is risk. So this is one that you might all be somewhat familiar with in terms of you need to determine what is your risk tolerance for your situation. So considering what's your time horizon for when you're going to need to access the funds, how many assets do you have accumulated, and then what's just your personal risk tolerance? Are you going to be able to sleep at night if the stock market drops 20% and your portfolio has dropped a large percentage as well? So you look at all those factors and you determine what is your risk tolerance, and then what is your asset allocation going to be based on that risk tolerance. So asset allocation is how much are you going to have allocated to the different asset classes there are. There are lots of sub asset classes, but the main ones you're going to think of are stocks, which are a higher risk asset with a higher expected return, and bonds, which are a lower risk asset with a lower expected return. Generally, for most of you in your stage of life with your long time horizon, you're going to be in a higher stock portfolio, lower bond portfolio. As you get closer to retirement, that's going to shift where you're going to get more in bonds and less in stock. For many of you right now, what's going to be appropriate for you is to pick one of the target date retirement funds in your 401k, 403b, and this is going to automatically assign you to an asset allocation based on the date you're selecting, and then it's going to shift that as you get closer to retirement, and it's going to rebalance regularly to that asset allocation. Rebalancing is when as the stock market changes, bond market changes, and you're not within those ranges that, let's say 80% stock, 20% bonds, it'll sell stock, buy bonds to get back to your asset allocation to keep your risk where it's supposed to be. So I highly recommend considering some of those target date retirement funds for you. The next principle that you can control is cost. This is something that usually can be hard to find. It can be really buried down deep in some of the investment products you're in, but it's something you really need to be considering because generally you can get some of the same products for a much lower cost. So things to consider are trading fees. As you're buying in and out of mutual funds and stock, are there any fees associated with those transactions? You can be looking at commissions. Some of the products that you're being sold, annuities, insurance products, things like that. Are there commissions that are tied to them? Are there surrender charges if you were to try and get out of those products in the future years, things like that? And then for mutual funds and ETFs, there are expense ratios that you need to be considering. And so this is a percentage of whatever amount you have invested in that asset is going to be taken out each year for expense costs for that product. The average expense ratio is over 1%, but there are many low cost providers that can give you the same product or a very similar product for a much lower cost. Vanguard's the most common one or the most well known one, where many of their expense ratios are below 0.1%. So very much cheaper than the average expense ratio. So cost is something you control, something you consider. The last main investment principle you can control to an extent are taxes. So obviously you have to pay whatever tax rate you're in, your tax liability that your tax preparer tells you. But there are different strategies you can do to try and control that tax rate and or control what tax bracket you're in. So if you're in a low tax rate year for any reason, you could look at accelerating income. If you're in a high tax rate year, you could look at accelerating deductions, doing tax planning like that. But when it comes specifically to your investments, what you want to be considering is the different type of accounts that you have. So in the previous video, I walked through retirement accounts, tax deferred accounts, Roth IRAs, things like that that have different tax rules for how they're taxed. And then there's also just a general brokerage account that's just a taxable account. And you want to be looking at what investments do you put in each account based on how they're taxed and making sure that you're being efficient with that. An example might be any investment that is having qualified dividends paid out. You might want to put that in your taxable account so you're getting that advantage of the qualified dividend tax rate compared to putting it in a retirement account where you're going to pay ordinary rates on that in the future. So just different things to consider there. Then the main investment principle that most people care about and you actually have no control over are returns. So what I mean by this is returns are unpredictable, at least in the short term. You can look at the average historical stock market return over a long term period, and that you can kind of at least guess what the average return is going to be over a long term. But in the short term, it is completely unpredictable. There are too many factors that go into the market and impact it from actual things with that company, with their underlying financials, things with politics. There's just way too much that goes into it. So you cannot predict returns in the short term. All history and all data points to that. But this feeds into generally main investment philosophies of active investing. Those are the money managers, fund managers who are trying to pick individual stocks, pick individual companies to where they're going to beat the average stock market return. And there's passive investing. And this is where you are investing in a very diversified portfolio, an index ETF, something like that, where you're just trying to capture the total return of the market. So these are different investment philosophies you want to be looking at, and consider the fact that history tells us you can't predict the return. No one can consistently beat the market. So once you kind of understand those main principles of investing, you then want to look at what are the different factors you want to be considering when it comes to working with a financial planner or advisor. So many of you are probably already being reached out to by different advisors and planners saying that you need to work with them, you need to engage with them. So what are the things you need to be looking at? One of the things that many in the financial industry won't really tell you is financial advisor, financial planner, wealth manager. Everyone uses these terms, whether that's what they do or not, and they use them interchangeably. So what you want to do is look at the underlying, what is this person actually doing? What are they selling me? Are they truly giving me a financial plan and working through that? Are they just going to be my stockbroker? Are they selling me insurance products? What are they doing? So you want to kind of look past that first title to see what are they doing for you. Then you'll be looking at the costs associated with that. There's a couple of main different types of compensation methods for those in the financial industry. Probably the most common one is commission and referral fees. So these are those who might be selling you an annuity, an insurance product, whole life, universal life, things like that, where they are getting a commission directly if you purchase that product. Or they might be getting a referral fee if they send you to a specific individual to work with, things like that. Another compensation method is fee-based. This is exactly what it sounds like. You're paying a fee directly to the advisor, and that's the base of their compensation, but then they can also still accept commissions and referral fees. And then lastly is fee only. And so this is like what my firm is, where fee only is also exactly like it sounds. You pay a fee directly to the advisor, and that's the only compensation that advisor can receive. They cannot legally call themselves fee only and then accept commissions, referral fees, things like that. So the reason the cost is important is one, like we just talked about, you want to understand the cost that you're paying. But two, you want to understand is there any conflict of interest with the advice I'm getting or the product that I'm being sold? And as you can tell, some of those compensation methods have a little bit more conflict of interest than others that you just want to be aware of before you can make an informed decision. And then the last thing that you really want to consider when it comes to working with a financial advisor or planner is, are they a fiduciary? A fiduciary is someone who is legally obligated to put your interest above their own. And if somebody won't say that they're a fiduciary, that might be a red flag. There are many out there who will say they are working to fiduciary standards, but you want to make sure that you are working with an actual fiduciary who is putting your interest above their own. All this being said, though, you really need to be considering, do you need to be working with a financial advisor or planner at this stage of life or not? Really, for many of you, like I said, you can consider investing in a target date fund in your retirement plans, maybe get some advice on student loans and how to handle that. But for most of you, you probably don't have the complexity yet that you really need to engage with a financial planner. And you can probably kind of handle it on your own for now. And then as your complexity grows, as your assets accumulate, and you've got just more that you don't know what to do with because it's getting harder to figure out how to invest, that's probably when it's time to start looking at an actual financial planner to engage with. And the last thing to look at with investment planning and really financial planning as a whole is you want to be tracking your net worth. So net worth is simply your assets minus your liabilities. And so your assets are anything, any of your assets that hold value or appreciate in value. So your house, your actual investments, things like that. Don't include like a car or anything like that that's going to lose value over time. And then you subtract out your liabilities, so your student loans, your mortgage, things like that, to get your net worth. You need to be calculating this on a regular basis. Start now if you aren't already. Calculate it yourself in Excel or some other software, and calculate it at least every year so that you can track, is your net worth improving and growing. Right now, it's probably negative if you have significant student loans, and the goal is for that to grow quickly. And this is going to be the best gauge of your financial health and financial progress. So then moving on from investment planning, we're going to look at insurance and estate planning. So this is where you're working to protect those investments as they grow and insure against them or insure them. So the first type of insurance that you need to be looking at or considering if it's appropriate for you is life insurance. So those who have dependents who rely on them and their income, so aging parents, young kids, things like that, you need to be considering life insurance. You likely need a policy. You might be having advisors reaching out to you saying that you need a universal life policy, whole life policy. These are extremely expensive products that are really a better fit for someone who has a large amount of accumulated assets, and this is kind of another investment tool for them. For most people starting out, most younger individuals, the best policy to consider is a level premium term policy. This is going to be a very cheap policy for you to get if you're young and healthy, and you can get you generally a 20 to 30-year term to where this is going to hopefully last you until either you have less dependents in the home who rely on your income, and or you've built up enough assets to self-insure to where if something were to happen to you, you've got enough investments that it's going to be able to cover and care for your family if something were to happen. But overall, you just need to consider, do you need life insurance, and is level premium term what's best for your situation? The next type of insurance to look at is disability insurance. This is one that can kind of be easy to overlook, but really all of you need disability insurance. Arguably, it's more important than life insurance because statistically, you are more likely to be disabled to the point of not being able to work than you are to have an early death. So you all need to be looking at and getting like our disability insurance. You'll get your own occupation insurance. So this is a specific type of disability insurance to where if you are disabled to where you can't do your own occupation, then you'll be eligible for benefits. So you'll make sure you have own occupation. You'll look at group policies versus individual policies. So you might be offered short-term or long-term disability insurance through your employer, and that can be a good cheap option. If not, you need to be looking at individual policy. Use an independent agent to shop around for those policies and get the best deal you can. Likely you'll qualify for a few $1,000s of coverage right now, which is sufficient. But as your income grows, as your assets grow, you need to be getting higher levels of coverage in the future. So then let's turn to property and casualty insurance. This might be the insurance you're really the most familiar with. Your auto insurance, homeowners, renters, things like that. Here, I've kind of said here the end goal is to self-insure as similar to life insurance, but what's different is there are obviously types of auto insurance you're legally required to have, things like that that you can't just self-insure against. But where you can self-insure is you can get a higher deductible if you can. You can opt out of some of the different types of auto insurance, and you want to consider that when you've got enough cash flow and enough assets that you can really take on that risk yourself. Overall, though, the main thing for these policies for you being a higher income individual is you need to be getting the high liability limits on these policies. And then that kind of feeds into the next policy, which is umbrella insurance policy. This is exactly like it sounds. An umbrella policy covers your other insurance policies to add another layer of liability protection if you were to max out the liability limits in your other policies. You can generally get $1 to $3 million for pretty cheap, usually a couple $100s a year. And as your assets grow, you're going to need to increase that amount and make sure that you've got that because, like I said, you are a high value target for litigation, so you want to make sure that you have those high liability limits. Along those lines, something you're also probably already familiar with is malpractice insurance. This is generally going to be provided by your group or your hospital that you're working with, and you need to make sure there's sufficient coverage. If for some reason it's not provided, you need to make sure you get it. You need to make sure that you have a high liability limit there as well, particularly if you are in a higher risk specialty. If you are a surgeon or something like that, you need to make sure you've got sufficient malpractice insurance. So then moving on from insurance planning, I'm going to briefly just talk about estate planning. And really the main thing to look at here is to consider, do you need estate planning at this point yet or not? So there are really two main scenarios where you need to go ahead and engage an attorney to do an estate plan for you. The first is if you have dependents, young children, who they're going to need a guardian if something happens to you and or your spouse. So then in the will, you'll name who will be their legal guardian, who will be the trustee to handle their assets, things like that. Or another situation that you need to go ahead and look at estate planning is if you just have significant accumulated assets, that you have a specific way that you want those assets divided up upon your death, then you need to go ahead and look at an estate plan. But besides those two scenarios, if you're not in either of those scenarios right now, you likely don't need an estate plan yet, but you want to keep that in mind as you progress through different stages of life of when you need an estate plan and how often you need to kind of be looking back at that and updating those. So that concludes the second video in this series on financial planning for resident physicians. I did that. It was pretty high level of those topics. So if you have any questions, please feel free to reach out to me or another fee-only financial planner you trust or a student loan advisor. But yeah, let me know if you have any questions and thank you.